Welcome to Chapter 1, the objective of general purpose financial reporting. At the onset, let us be clear that what this chapter refers to is general purpose. It means that it does not include special reports. Financial reporting, meaning we are not only talking about the financial statements, we are dealing with a broader concept of financial reporting, of which the financial statements are merely a part of. Let's get started. The objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions relating to providing resources to the entity. Now, we all know that there are numerous users of financial information. There's management, the creditors, the suppliers, the employees, the shareholders, the government, and even the general public. But the conceptual framework makes it very clear that when we talk about general purpose financial reporting, the information reported caters primarily to existing and potential investors, lenders, and other creditors. That is why these parties are called primary users of the financial statements. The other users of financial information may also find the general purpose financial reports useful. However, these financial reports are not primarily directed at them. Take note, general purpose financial reports are not designed to show the value of a reporting entity, but they provide information to help existing and potential investors, lenders, and other creditors to estimate the value of the reporting entity. Now that we know the parties being primarily considered, let us now understand what decisions they need to make and what information they need. Put yourself in the shoes of a prospective investor. You would most likely make decisions regarding buying, selling, or holding debt and equity instruments, right? And this is an important decision to you because it could spell out whether you will be receiving dividends in the future or earnings from market price changes. Imagine yourself now as an existing equity investor or a shareholder. It would be important for you to decide whether it is necessary to exercise rights to vote or influence management's decisions in order to hold management accountable. What if you're a lender or creditor? Wouldn't you need to make decisions on providing and settling loans and other forms of credit? Questions like, would the entity be able to repay the principal and the interest on time, naturally concerns you. For every decision that a primary user makes, there is always a corresponding consequence. Because of the consequences or results embedded in the decisions that users make, general purpose financial reporting must provide relevant information regarding the reporting entity's economic resources and claims. Quite obviously, as an existing or potential investor or creditor, you would like to know the financial position of the reporting entity. What are its resources and what are the claims against these resources? This information can help the users of the information gain insight about the entity's strengths and weaknesses, including liquidity and solvency, and its need for additional financing. Secondly, you would also need to provide information regarding the changes in the said resources and claims. Now, there are basically two types of changes in an entity's resources and claims. The first one referring to changes from the results of financial performance, and the second one referred to changes not resulting from financial performance. Let's go back to the first one. When we talk about financial performance, we immediately think about profit or loss. However, the conceptual framework points out that when we talk about financial performance, we have to be mindful about financial performance reflected by accrual accounting. We all remember accrual accounting, right? The one which depicts the effect of a transaction regardless of when cash is received or paid, and financial performance reflected by past cash flows. Quite obviously, cash flow information is very important as it helps users understand the reporting entity's activities pertaining to operations, investing, and financing. For changes not resulting from financial performance, we refer to other events and transactions such as the issuance of debt and equity securities. For example, think changes owing to issuance of shares of stocks. This information is important to help users determine the implications of such to the entity's future financial performance. For example, the issuance of debt securities would tie up the business with future payments of both the principal and the interest. Thirdly, we would also need to provide information about the use of the entity's economic resources. This information is necessary in order for the users of the information to appropriately assess the effectiveness and efficiency of management and discharging its stewardship function over the entity's resources. For example, how has management protected its most valuable assets? How does management ensure that laws and regulations are complied with? And that's Chapter 1. To summarize, here are our major takeaways. The primary users of general purpose reports are existing and potential investors, lenders, and other creditors. We need to provide them information with regards to resources and claims, changes to resources and claims, whether it be as a result of financial performance, both from accrual and cash flows, or as a result not coming from financial performance, such as debt and equity issuances, and as well as information about the use of the entity's resources. Whenever you're ready, I'll see you in Chapter 2, Qualitative Characteristics of Useful Financial Information.